Hello, my friends. Happy New Year. It's the 4th of January and it's really, really exciting to actually start work. I have my partner Susan here, and we were interviewing for the job of working with a buyer over the holidays, and Susan had the great idea that we should actually make a video, because all the questions that our prospective buyer was asking were really, really good questions, and we thought that we can make a session and just talk about all those questions and discuss all the steps that go into a purchase, and that way all the other buyers who are looking can learn from this. And Susan and I, we thought about doing a role play and teach you what goes into the process. Susan, are you ready?
I am ready.
All right, very good. Well, I'm going to start with putting Susan's information on the screen so that everybody knows to get a hold of Susan. So that's her phone number. And there is Susan's email, and as a pro, Susan, about the one that you just opened Escrow. Congratulations on doing that.
Yeah, thank you. Yes, really nice couple doing their first time home purchase, and we found a great place for them and just getting started in the escrow process. So it's perfect timing because all of this is going through. I can use them as an example going through of the steps, but I'm really thrilled to help these buyers get a great place.
Yeah, wonderful. Okay, all right. So let's start role playing. So I guess I'm the realtor and you are the prospective buyer.
Okay.
Great.
So I'm thinking about buying a house or a condo, and all I've done so far is I started talking to a mortgage person to try to understand what I can afford to buy. What else do I need to do going forward?
Okay, so you started with the lender, first step, and what was your budget?
Well, I'm still trying to figure that out. The lender said that I can afford with my income up to $650,000, but I don't understand really how the payments are going to work with everything that's included in buying a place.
Okay, so that's a great step, and $650,000 is a healthy bit. So I'm going to share screen, and we're gonna go through some numbers just to figure exactly what your budget looks like and how much house you can afford. Sound okay?
Yeah, that sounds great.
All right, very good. So here is my name. So as you can see, I've started with I started with a conventional loan, and Susan, will you explain what a conventional loan is?
You want me to explain it? Is that what you said?
Sure. Yeah.
Yeah, so there are different kinds of loans when you talk to a loan officer, and depending on your income and your amount that you have for a down payment, you can get different types of loans. They're typically conventional loans, FHA loans, and veterans loans if you're a active or retired military. So, yeah, so.
FHA, so the down payment for an FHA loan.
You broke up again, but I think the down payment for FHA loans are typically a smaller percentage. So, but the tricky part with FHA loans, if you're looking to buy a condo, is the condo complex has to be approved to accept that sort of loan. So it can limit the places that you're eligible to buy.
Correct. And for an FHA loan, the down payment is 3.5%. But so I'm going to change my loan limits here to 3.5%. And then this gives me, so my let's see, my price here is at $500,000, and if I'm putting 3.5% down, these are the breakdown of the numbers. The biggest thing is the MIP, or how I call it is PMI. I like to call it PMI, but that's basically what it is. The monthly mortgage insurance premium. Basically it's an insurance the buyer is paying to the lender for the money that they have borrowed. Okay, but in this case, what about a VA loan? How much down payment does a VA loan need?
I'm not honestly sure. Well, actually, VA loans, you can put 0% down.
0% down, right? And because you're active or you are military, the benefit is that you have a PMI because the VA believes in you that you won't foreclose on your place, so they don't need to actually set insurance. And I think in most cases, actually, very few VA actually foreclose. So that is actually that their members do not foreclose as often as the general population. In this case, we were dealing with a buyer that was looking to do a convention, which I'm going to change this to 20% because that's what he was going to put down. So let's see, with 20%, we also are eliminating PMI, and those were the numbers. Start with the lender. We went over it correct. And then the next question was, what are costs? And you want to go over closing costs?
Right. So I can't really see that specific example. It's a little small on my screen, but basically it's covering the costs for all of the administrative stuff for buying a house. So the escrow fee, they're going to charge you a fee for being the company that's basically the neutral party that's handling the money throughout the transaction. The title.
And the title, right.
Yeah, and you also pay some title insurance, and that's basically a company that says this person actually owns this home, and then when you go in to buy it, they transfer that title over into your name. And so there can be cases where there might be some long lost relatives that thinks they own the home, and so you want to have that title insurance to make sure that you're buying this huge investment and that it's going to be in your name.
And there's no other person that claims they own a part of it.
Exactly. And they also take a look and make sure there aren't any outstanding liens or loans on the property, and so it's just a way to protect you from, potential hassles in the future that you might not know about without the title company. And
right.
Then typically the lender charges an origination fee, potentially other fees throughout the process. So the cost of buying a house is not just $650,000. There's other things that you have to bring to the table in order to be able to facilitate the purchase.
So in this case, we were looking at $12,592, and that's the amount of closing costs that the buyer would have to bring, plus the 20% of a purchase $500,000 would be $100,000. So we're looking at having to bring to the table $112,592. Okay, so let's see. Let's assume that we've opened escrow. What are some of the steps that the buyer was asking for? Do you recall?
Some of the questions, is that what you said?
Some of the questions that the buyer was asking for.
Yeah, I think he was just kind of saying what are the main steps, and I think what a lot of people may not know is there are deadlines throughout the escrow process that you go through. The first kind of big one, usually the biggest one, is the buyer's investigation. So that means a general home inspection, any other inspections you might want to do on the property. If you're buying a condo or a townhome, you look through the HOA docs, the financial information to see the health of the homeowners association. And so
I had a buyer that was asking me about that. And she was asking, why do you need to know the health of the homeowners association? Why would that concern me? Right.
Well, here's a perfect example that I've had happen to me. When you look through those documents, you can also see the meeting minutes from the HOA board. And sometimes HOAs say, well, we need to get a new roof for the whole complex, and we don't have enough in our, what they call reserves. Basically, that's the money you're putting in with your dues every month. So we're going to have to charge every homeowner, $8,000 as a one-time fee. Well, that's really important for you to know before you buy that place, because then you can try, as your agent, I would try to negotiate that you get an extra $8,000 off the price of the place or as a credit, because that's something you need to know ahead of time. So, and HOAs can, not have enough in reserves. It's just good to know kind of what your HOA looks like before you become part of it.
And also that shortage in reserves could also affect your loan that you're getting.
Right.
To know that kind of information.
Right.
So what about physical inspection?
So I usually, when I go under contract with buyers, I want to try to get that inspection started as soon as possible. And so you'll have a general home inspector come who looks at the bones of the house, the major, foundation, electrical, plumbing, all that kind of stuff that you might not be able to see just from walking through. And then you can identify any potential issues or things that aren't working with the property. And within that window of time frame where you're doing your investigations, then you can negotiate with the seller to try to get a credit to repair those items.
Now, when we were talking with this buyer, we were talking about rather than having the seller do those repairs, actually get those as a credit, which then you could apply towards your closing costs as a credit, because it's always safer to have yourself do those repairs rather than rely on the seller, because sometimes the seller may say, yes, I will do those repairs, but if they don't do it as through a general contractor or somebody that's reliable, then you don't know that they've been done for sure. So I'm going to actually put those, let's see if I can apply a credit towards this. I don't know if I can apply a credit.
I don't know on that. I think if you go back to the main screen, you can put in like repair estimate or something, and it might take it out.
Yeah, well, anyway, so if in case we're talking $12,000, the closing cost, you would, and let's say you get a credit of $3,000 towards repair, you could reduce your closing costs to be let's say $9,592 instead of $12,592. So this way you have to bring less money to the table, right?
Right, exactly.
Okay, very good. So I'm going to go back to okay, so now we've negotiated our physical inspection, and the next step is appraisal. So the next question that the buyer was asking for was why do I have to do an appraisal?
Exactly. An appraisal is kind of another insurance for the bank to make sure that the asset, which is the property that they're funding, is worth what they're putting, what they believe it is valued at. So if they, if you get a property and the appraisal comes in lower than what the bank is funding you for, financing you for, that's bad for them.
And those, so what happens? Let's say appraisal comes back lower than contract price. What happens then?
Yeah, then it's sort of like the investigation contingency. You kind of have a renegotiation period where you say, okay, look, seller, the house isn't worth what we're under contract at. You need to lower the price. We need to split that cost. We need, that becomes a secondary negotiation on the price.
Exactly. Okay, so we've gone past the appraisal period, and now we're looking at. Let me see. We had one over here about. Let me see this one.
Oh, okay. So the contingency removal we talked about. There are usually three main ones: the investigation contingency, which is your home inspection mainly, the appraisal contingency, and the loan contingency. And each one has a deadline. And as soon as you say, okay, we're satisfied that we've done the investigation, we're going to remove the investigation contingency. That's one down. Then you get the appraisal. It comes in at value. You remove that contingency. And the final one is the loan contingency. And that's when the lender says, we've reviewed all your documents. We've reviewed the contract. We've got everything wrapped up. You're good to go. We can definitely do this loan on this home. Then you remove the loan contingency. And once all those contingencies are removed, then you as the buyer are committing to moving forward with this purchase. And if you were to back out as the buyer after you've removed all contingencies, you could put your earnest money deposit at risk, which, could be thousands of dollars.
How much money are we talking when we're talking about earnest money deposit?
Usually it's between 1% and 3% of the purchase price. So if you're, a $600,000 home and you put a $6,000 earnest money deposit, if you back out after you've said, I'm okay with all of these deadlines and everything looks good, then the seller can get your $6,000 earnest money deposit because it's like a breach of contract.
Usually even more than that because, for example, when I represent sellers, I always ask for 3%
right.
deposit. Yeah.
Exactly. Yeah, it can be thousands of dollars.
Thousands of dollars, exactly. Okay, we've removed contingencies. Now what?
Well, the main thing that's left to do after you've removed all contingencies is to make sure you've got everything set up with your lender. Your lender's going to talk to you about signing all the lots and lots of pages of loan docs, and that's going to finalize the financial part. And then the kind of last thing you do with your agent is to do a walkthrough of the property, usually a few days before closing, just to make sure that it's still in fundamentally the same shape as it was. It's not to really check anything in detail. It's just to do one final check. And then you say, yep, we did our final walkthrough.
Final walkthrough. That's right. So we have to do this step. We have to do that. We move to the settlement statement. So, usually at one point we also have to bring that 20% down to the table.
Right. So the settlement statement, which is also now called the closing disclosure, the CD, your lender may tell you that when you get to this point. That is where all the bean counters got together and figured out exactly what you, the buyer, have to bring to the table. So you've already put in your earnest money deposit. They are going to look at daily interest rates, HOA, potentially prorating different days. So it's going to be a very specific number on that final closing disclosure. And that's when you will wire that exact amount to escrow. And you will have done your part as your part of financing the loan.
Right, exactly. So then now all the money is in escrow. You've signed your loan docs. You've the notary has taken all the loan docs back to escrow. They've checked everything. Everything is balancing out. You've got your loan docs signed. You've got your down payment brought into escrow, and then the final step. That actually in California, you don't need to go to a closing table, right? Basically.
It's a little anticlimactic. A lot of people go, what do we do? Where do we go? I'm like, well, we basically just usually you get a clear to close from the lender, and the escrow says we're in line at the county recorder's office, and the title officer will record the deed into your name as the buyer. And they'll call me and say it's done, and I'll call my buyer and say, hey, congratulations, let's meet and I'll give you the keys and you get to move into your new place.
That's it. Final step. Woohoo! Get keys.
That's the best part.
That's the best part. Absolutely, absolutely. So, so that pretty much concludes the whole process from beginning to end. Of course, you know, there's sometimes a lot of other complications that go with it, but this is the nuts and bolts of it from beginning to end, right?
That's it. Yep.
All right.
You need a good agent to help you navigate all that stuff.
Absolutely, that's right. So thank you so much for being here, for helping me explain the process to our viewers. I am going to, let's see, put our contact information there one more time. Here's the email address for me, and here's my phone number. And I'm going to go through and post Susan's one more time. Here's Susan's email address and Susan's phone number. And we are here and would love to help you with your purchases if you're thinking of buying, or of course, if you're thinking of selling, we are here for that as well. So thank you everybody for joining us, and Susan, thank you so much for joining me.
Yeah, it was fun. Thanks for inviting me.